Hello, everybody. This is Alan Ellman, the Blue Collar Investor, and welcome to this video tutorial of the BCI Poor Man's Covered Call Calculator. Another name for the Poor Man's Covered Call is the Long Call Diagonal Debit Spread. Now, over the years, BCI team has created a multiplicity of calculators. This particular calculator has the most formulas in it, has been the most challenging to create, and we're very, very proud of this tool. Let's start this tutorial by giving a brief overview of what the Poor Man's Covered Call is, and then we'll get right into the calculator. Now, this is a strategy that is similar to, but not precisely the same as traditional covered call writing. The difference is, instead of buying a stock and then selling call options against that security, we buy a deep in the money leaps option or a long-term expiration option. And that will serve as the stock surrogate or replacement. Now, because we're buying a leaps option with a long-term expiration, this happens to be a long-term strategy. For traditional covered call writing, we're normally writing weekly and monthly options, and frequently we're over, our portfolios are turning over fairly frequently to avoid earnings reports. So this is a long-term strategy. Now, because we are buying an option instead of a stock, our cost basis is much lower, and therefore the return on our capital is much higher. And this is the main attraction of the Poor Man's Covered Call. Now, like every single other strategy, there are pros and cons to the Poor Man's Covered Call, which we all must master and understand before making a decision to use this strategy in our portfolios. Now, a chart of the pros and cons of the Poor Man's Covered Call is located on page 105 of our book, Covered Call Writing Alternative Strategies. We also go through them in the online video course, The Poor Man's Covered Call. Let me give you an overview of the calculator. The 5 tabs on the calculator will start by determining the initial trade structuring of the Poor Man's Covered Call trade and the status at that point in time. The remaining 4 tabs are related to position management. It will calculate various position management price points. It will also determine exit strategy buyback price points for us. So given anything that can occur related to the price of the underlying security in the same month, in the next month, related to much further down the road when we're looking to roll the leaps options, the calculator will do all these statistics for us. Now, this is an overview of the calculator with the 5 tabs. Now, each tab can be accessed from the very bottom of the spreadsheet down over here. And only 4 of the tabs are shown in this screenshot. There wasn't enough room on this slide to give you the 5th tab, but you could see the 5 bullets. So we're going to start with the initial trade structuring tab. That must meet a certain formula. We want to make sure that if the trade is closed early, it closes at a profit. So you must adhere to that formula, which again is in the book and video course. Now, the second tab relates to trade management of the short call, which is really the active leg of the trade, the short call, slightly out of the money call option. And the second tab relates to management of the short call in the current month. And the third tab relates to management of the short call in the next month, or more specifically, rolling the options. The 4th tab relates to management of the leaps itself, because like all options, leaps options will expire. And at some point in time, if you want to remain in the trade, you're going to have to sell that leaps option and buy another one. You got to roll it out. So the calculator will do all the math for us in terms of rolling out 1 year, rolling out 2 years. So that's an important tab to have related to the long aspect of the Poor Man's Covered Call trade. Now, in the BCI methodology, we give a guideline of rolling the leaps option approximately 90 days prior to contract expiration. This way, theta won't erode away all of the time value left when we sell that leaps option. And finally, The fifth tab on the calculator relates to closing the trade early. What happens if the price of the stock goes to the moon? And we don't want to put more money into it by buying that deep in the money call option back. So we close the trade. And the fifth tab, as you'll see shortly, will let you know your position at that point in time if you close the trade early. So let's get started now with looking at an overview of the Poor Man's Calculator spreadsheet. And this just shows you that for the first tab, for the initial structuring tab, that information is entered into the blue cells at the top portion of the spreadsheet over here. That's all taken from the option chain. The calculations will appear here, and then specific critical target dates and buyback points are indicated at the bottom of the spreadsheet. So I wanted to give you an overview of the calculator, and then we'll take a closer look as we start entering our trades. Okay, here we go, folks. We first enter the initial trade date on the top for the option month for the short leg of the trade. So you see the trade was entered on 12/21/20, and we're looking at the January 5th, 21. So that will end up down here. And today's date is December 21st. So you're looking at a 25-day trade from 12/21 to 1/15. 2021. Now, once the initial trade date is entered, we look at the current market value of the stock. Remember, we're not buying the stock, but we're going to buy a surrogate or the leaps deep in the money leaps option or strike much lower than that 36.73. In this case, we're going to look at the $20 deep in the money leaps option. What is that going to cost us? It's going to cost us $16.90 in this hypothetical. 1673 is intrinsic value. The amount that the strike is lower than current market value. 17 cents time value. So 1690 is what that leaps option will cost us. Now we're going to look at the 2-year expiration going out to January 20th, 2023. So it's a 2-year leaps option. And now back to the strike, the out of the money short leg of the trade. And that's the 37.50 strike. Could show you over here. And that generated 66 cents. So that information is entered into the blue cells at the top part of the spreadsheet. And lo and behold, the calculations will automatically appear in the green cells in the middle part of the spreadsheet. Remember, we're still in the first tab, initial structuring. So the information here, we mentioned before, it's a 25-day trade. And we want to make sure, this is the key tab here now, that there's a positive number for the initial trade. In other words, if it's closed at that point in time, it closes at a profit of $1.26 per share, which would then represent a 3.91% 25-day return. Now, if the price of the stock moves up from current market value to the 37.50 strike, there's an opportunity for an additional 4.56%. That means there's a potential for an 8.46% 25-day return, which annualizes out to 123%. Now the max profit is 126, as we showed you over here. And the break-even point is 36.24. In other words, if we close the trade when the stock is trading at 36.24, we have a net zero return. It's a break-even point. What's our maximum loss? Well, the price of the leaps option, 1690 minus the 66%, 66 cent rather, short call premium. So the max loss is $16.24. So that information will appear in the tab 1, initial structuring of the trade. Keep in mind, we want to make sure that there's a positive number for the initial trade row in the calculator. Let's move on now to the second tab, which is trade management of the short call in the current month. Now, since we are taking a long-term position, we could both roll down and roll up in the same contract month. If we were doing traditional covered call writing, I will very rarely roll up in the same contract month. But this is different. We're taking on a 1 or a 2 year commitment. And therefore we may roll up in the same contract month because we know we're staying with the same stock. So let's have a look now at two situations. One, when the price of the stock goes down, and the second one, when the price of the stock goes up. So let's say it goes down from the 36 and change to the $33 current market value. Everything else was the same. And what we're going to do is we're going to roll down from the 37.50 strike. We're going to roll down to the 35. Now, since the price of the stock is currently 33, that 35 strike is an out of the money strike at that point in time, even though we're rolling down. So in this hypothetical, the cost to close will be 15 cents. Remember, the price of the stock that goes down will also cause the value of the option premium to go down. So we could buy it back at a much lower price than what we originally sold it for. Now, because we're rolling down, we're going to get a higher premium than the cost to close, in this case, 50 cents. So we have a net profit on the option side of 35 cents, which results in a 2.16% rolling down percent credit. Now, what if the price of the stock goes up and we want to roll up? Let's have a look. Let's say the price of the stock goes from 36 and change up to 42. Right now, the cost of the $42 makes the 37.50 strike, 4.50 in the money. So to buy it back is going to cost us 4.50 plus some time value component. Let's say 50 cents, totaling $5. Now, we're going to roll up. The price of the stock is 42. We're going to roll up to the 44 now out of the money strike. Right? So let's say we generate a premium of $1. Well, we're losing money on the option side because we closed at 5 and we reopened the new position at 1. But remember, our shares, which were originally capped at 37.50, are now up in value to an unrealized profit of 42. So up 4.50. Put that together with the $1, we now have a rolling up credit of 3.08%. That's what the calculator will tell us regarding both rolling down and rolling up. And the information related to the numbers, you just feed them in. What is the current market value? Went down to 33, went up to 42, whatever it is. And then you can put in the strike prices and see if the time value credit meets your strategy requirements. All right, let's move on now to the third tab, which is trade management, moving the short call to the next month. Generally, that means rolling the option that is in the money as expiration is approaching. So for this tab, let's go with the assumption now that the price of the stock moved up from 36 and change up to 38, which makes the 37.50 strike in the money. And let's say the cost to close is 55 cents. So intrinsic value of 50 cents plus a few pennies of time value as expiration is approaching. Now, if we rolled out, that implies we're going to the next month, same strike. So we're rolling out to the next month, 37.50 strike, which is the same one for the near month. And let's say that generated a premium of $1.10. Well, the calculator will show us that we have a rolled out time value credit of 3.39%. Now, what if we're more bullish and we want to roll out and up? In this case, we're going to roll the cost to close is the same, 55 cents. And instead of rolling out to the same 37.50 strike, we're going to take a more bullish approach and roll out and up to the 40 strike. Well, you could see the premium is $1. And we also have bought up value of our stock from 37.50 to the current market value of 38. That will result, those two factors will result in an initial time value credit of 5.85%. So I would go with the rolling out to the same 35.50 strike if I want to take a little bit more of a defensive position. And if I'm really bullish on the market and the stock at that point in time, I would roll out and up to the 40 strike. Calculator will give you the numbers to help you make those determinations. Okay, let's move on now to rolling the long call leaps. Every option expires. In the case of leaps, it expires 1 year out or 2+ years out. In this particular case, the spreadsheet will show us. So initially, we went with the leaps in January 2023. Today's date is November 2022. In the BCI methodology, the guideline is to roll your leaps option about 3 months before expiration of the leaps contracts, so theta hasn't completely deteriorated the time value remaining when we sell the leaps options that we purchased when the trades were initially set up. So we're going to go 3 months before the January 2023 expiration to November 2022. Now, selling the leaps will result in this hypothetical in a bid price when we sell the option of $9.90 per share. Now, to roll the leaps out 1 year would cost us $11.90 a share, and to go out 2 years, $13.20. So initially, it looks like, wow, it's cheaper to do 1 year than it is to do 2 years. Because if you look at the debit on the 1 year, it's $2 per share, $11.90 minus $9.90. And on the 2 year, it's $3.30, $13.20 minus $9.90. But if you took this information and you figured it out on a per month per contract cost, you would see that the cost is greater for the 1 year, rolling out 1 year, than it is for rolling out 2 years. So generally speaking, if you want to stay in the trade and you have a long-term commitment, you may want to favor that 2 year rolling out to the 2 year leap, where the cost per contract per month is cheaper. Okay, now we're going to finally do the fifth tab, which is closing the trade early. What if the price of the stock goes to the moon? And you don't want to, you're going to have to buy back that short call. It's going to be very expensive. You're going to have to put a lot more money into the trade. You may not want to do that. So what if the price of the stock went from the original $36.73 up to current price of $50 per share? All right, what's it going to cost us to close the trade? Well, we bought the $20 strike leaps option, and now the price is $50. That means there's $30 of intrinsic value, and that's what we're going to get if we sold that option, $30 per share. Right now, what about on the and we originally paid $16.90, so we have a credit of $13.10. Now, what if about on the option side? Remember, we got 66 cents when we sold the original short call, but now that 37.50 strike is in the money by 12.50. And if we add a little bit of 50 cents of time value to that, say it costs us $13 to close that short call. So we have a debit of 13, we had the original credit. Net, we have a debit of 12.34. Figuring out those two, we end up with a credit of 76 cents per share. And based on our original cost basis of $16.90 minus the 66 cents for the initial premium, that results in a 4.68% credit in whatever time frame we had that particular position, based on the statistics shown in tab 5 of the BCI Poor Man's Covered Call Calculator. So tab 5 once again results in figuring out the percent return if the trade is closed earlier. So we really have all bases covered: initial trade structuring, managing the short call in the current month and the next month, rolling your leaps option, and closing the trade early. Now, to access the Poor Man's Covered Call Calculator, what you want to do is log into our website, www.thebluecollarinvestor.com. Look for the store link on our web pages. Click on that. That will take you into our store, and then look for the section that has calculators and spreadsheets, and then you'll be able to look through the calculators and locate the Poor Man's Covered Call Calculator. For those of you who are using the Poor Man's Covered Call strategy, you're going to find this a very practical and useful tool. I believe that there is nothing like that anywhere else relating to this particular strategy, which includes both setting up the initial structuring of your trade and then managing it from start to finish. So ladies and gentlemen, thank you so much for taking the time to listen to this video tutorial on the BCI Poor Man's Covered Call Calculator. I hope you enjoyed it. And most importantly, if you're going to use this strategy, I hope it puts cash in your pockets. As always, this is Alan Ellman, the Blue Collar Investor. Take care, everybody.